Most people think getting into crypto is about finding the next 100x coin, but the real challenge isn't spotting the next big thing. It's not getting wrecked before you even understand how this space actually works. The market moves fast, it's ruthless, and if you're coming in blind, you're not early, you're just someone else's exit. There's a lot of hype and noise out there, and the learning curve usually kicks in after you've already lost money. So, in this video, I'm breaking down 10 things that most people don't tell you when you're new to crypto. No recycled Twitter threads, no vague quote, do your own research advice. Just the practical stuff I wish I knew earlier, based on real experience in the space. My name is Danilo, and I make educational crypto content to help you stay ahead without wasting your time. If that sounds interesting to you, make sure to hit that subscribe button and ring the notification bell so you never miss future crypto updates. Alright, let's get into it. Let's start with something that catches almost everyone off guard. If you've ever bought a coin after seeing a bunch of people post about it and it immediately dropped in price, you probably just played your part as exit liquidity. It happens all the time. A project gets hyped, the charts go vertical, and new buyers rush in thinking they're early. But in reality, they're buying someone else's bags. Usually the bags of people who got in first and are now quietly selling into that momentum. The mistake most beginners make is assuming a rising price means it's time to enter. But by the time it looks safe to buy, the real money's already been made. That doesn't mean every pump is a trap, but if you're chasing green candles without understanding what's moving the price, you're probably not the one in control. And nowhere is that more obvious than with the meme coins. Meme coins are one of the biggest traps for new investors. On paper, they look like the fastest path to massive returns. You see screenshots of someone turning a few $100s into six figures overnight, and it feels like you're missing out on easy money. But what no one tells you is that most of these plays are completely illiquid. The numbers might look insane on screen, but good luck actually cashing out. Let's say you buy a meme coin that just pumped 1000%. Your wallet says you're up big, but when you try to sell, there's barely any volume. Maybe there's only a few $1,000s of real liquidity. And if you try to exit your full position, you're the one crashing the price. That's when you realize the truth. Most people showing off big meme coin wins either got in ridiculously early, or are only holding paper profits, or conveniently forget to mention they couldn't sell a cent. Now, I'm not saying you can't make money on memes. You can. But the plays that work usually involve perfect timing, low entry prices, and an exit strategy. If you're chasing them based on hype, you're more likely to fund someone else's win than create your own. And even when you do hit a win, there's still one massive challenge: timing. One of the most common traps beginners fall into is thinking they can perfectly time the market. You buy something, it goes up, and suddenly you feel like you've cracked the code. But what most people don't realize is that in a bull market, everything goes up. It's not that you're a genius, it's that you're riding a wave that was already building with or without you. This is where people get stuck. They assume the pump will continue, they don't take profits, and when the cycle flips, they watch everything bleed. Timing tops and bottoms sounds good in theory, but in practice, even the smartest traders get it wrong more often than they get it right. Add in things like changing market structure, institutional players, and unpredictable news events, and suddenly, that clean-looking chart setup doesn't mean much. What works better is understanding the broader cycles. Historically, crypto has followed a 4-year rhythm tied to Bitcoin's halving events, with bull markets peaking about a year and a half after each halving. But even that's starting to shift as the market matures. The point is, trying to guess the perfect moment to buy or sell usually ends with you missing both. A better strategy is to position yourself early, scale in and out gradually, and stay emotionally detached from the noise. Speaking of things that trip people up, let's talk about one of the most misunderstood numbers in crypto. A lot of beginners get stuck on price. They see a coin trading at a few cents and assume it has more upside than something that's already worth hundreds or even thousands of dollars. But the number that actually matters is market cap, not price. And even then, most people misunderstand what market cap really tells you. Market cap is just the current price multiplied by the circulating supply. It's not how much money is invested into the project, and it definitely isn't a pool of cash sitting somewhere. It's a rough way to gauge how, quote, big a crypto asset is, but it doesn't reflect liquidity, fundamentals, or investor behavior. You can't just look at a token and say, if it hits the same market cap as Bitcoin, I'll be rich. That's not how this works. The smarter move is to compare coins within the same category. If you're looking at a small cap AI token, benchmark it against other AI tokens that performed well in previous cycles. See what kind of narratives drove them, what their market caps peaked at, and whether there's a real demand building. Don't fall into the trap of thinking a low price means high potential. It usually just means there's a lot of supply and not much else going on. And once you understand how to spot inflated expectations, you start to notice just how much junk is floating around in this space. There are an insane amount of cryptocurrencies in existence right now, and depending on how you count, including all the tokens that ever minted on chain, that number gets even bigger. But the reality is, most of them are completely useless. Some of them were created as quick cash grabs, others are abandoned projects, and many never really had a real purpose to begin with. Just because a coin is listed on a chart doesn't mean it deserves your attention or your money. This space makes it really easy to create something that looks legitimate. You've got slick websites, decent branding, and maybe even a community shilling it on social media. But that doesn't mean there's actually any value underneath. Most tokens don't solve a real problem, don't have consistent usage, and don't have sustainable tokenomics. Even the ones that do are often competing in crowded sectors where only a few winners will matter. The sooner you stop treating every new coin like a lottery ticket, the faster you'll start thinking like an investor. It's okay to explore narratives, try new ecosystems, or bet on small caps, but be selective. The people who survive in crypto aren't the ones who hold the most coins. They're the ones who can filter out the noise and focus on a few that actually have a shot at relevance. And even if you've picked a solid project, holding too long for the wrong reasons can cost you just as much as picking the wrong one. One of the biggest mistakes people make in crypto is getting emotionally attached to their bags. You buy into a project early, watch the price go up, maybe even join the Discord, and suddenly you feel like a part of the team. But here's the problem. The market doesn't care how early you were or how much you believe in the vision. If you hold for too long without a plan, those gains can disappear just as fast as they showed up. This is especially true for altcoins. Most of them follow hype cycles. They pump hard when attention hits, then slowly bleed out over months or even years. Waiting around for the next cycle doesn't guarantee anything. A lot of coins never recover. In fact, many from past bull runs never returned to their all-time highs, even when the broader market did. And don't base your conviction on what influencers are saying either. A lot of them are just talking their bags, or getting paid to promote something they'll never touch again once the video is out. Even this video, don't treat it as financial advice. Use it as a tool to sharpen your own thinking. At the end of the day, no one's coming to save your portfolio but you. But managing your portfolio is only part of the equation. The other side of the game is how visible and vulnerable you actually are. A lot of people assume crypto is private by default. It's not. The second you send your first transaction, your wallet becomes part of a public record that anyone can trace. Every transfer, every swap, every token you ever touch from that wallet is visible on-chain forever. It's not just transparent, it's searchable. This catches a lot of newcomers off guard. They think using a wallet means they're off the grid, when in reality, it's like doing your banking with a glass account. If someone knows your wallet address, they can see everything. And if you've ever posted that address publicly, connected it to an ENS name, or interacted with a popular NFT, chances are it's already linked back to you. Now, there are ways to protect your privacy, but they take extra steps. You can use fresh wallets, mixers, or privacy-focused chains like Monero, but even then, nothing is guaranteed. The more you interact on-chain, the more dots can be connected, so don't confuse decentralization with anonymity. Crypto is transparent by design. And in a world where governments are getting more sophisticated with blockchain analysis, pretending this stuff is invisible is a fast track to trouble. And if privacy is step 1, custody is step 2. Because what good is protecting your activity if you can't even control your own assets? If you don't control your private keys, you don't own your crypto. It's really that simple. Leaving your assets on a centralized exchange might feel convenient, but it comes with risk. And not just the obvious ones like getting hacked or the platform going down. When your crypto sits in someone else's wallet, you're trusting that they'll always give it back. History says that's a bad bet. We've seen this play out over and over again. Exchanges collapse, withdrawals get frozen, assets get mismanaged, rehypothecated, or flat out stolen. And when that happens, there's no FDIC, no customer support line that fixes it, and no way to recover what's gone. The only protection is holding your crypto in a wallet where you control the keys. That doesn't mean you have to go full hardware wallet from day one, but you should know how to use one. Even a simple self-custody setup with a trusted wallet can make a massive difference. Learn how to store your seed phrase properly. Practice sending test transactions. Know what you're signing when you connect to decentralized applications. Because once you start playing with real money, custody isn't a feature, it's your responsibility. But even if you're doing everything right, the rest of the world isn't quite here yet. And that's something most people overlook. If you spend all day on crypto Twitter, it feels like the whole world is already on board. But go ask 5 of your friends if they've ever used a wallet. Most haven't. Some still think Bitcoin is a scam. That disconnect tells you everything. Crypto isn't mainstream yet, not even close. As of early 2025, only a fraction of American adults own any crypto, and globally, that number drops to around single-digit %. Most people still have no clue how to use a wallet, interact with DeFi, or understand what any of this actually enables. We're still in the early adopter phase. That's not an issue, it's the opportunity. But early doesn't automatically mean profitable. You still need to know what you're doing, manage your risk, and be willing to stick around long enough to benefit when the rest of the world finally catches up. And that brings us to something most beginners learn the hard way. A profit isn't real until you've locked it in. It's easy to get caught up watching numbers go up. You buy into a coin, the price pumps, and suddenly your portfolio looks way better than it did a few days ago. But until you actually sell, those gains are just numbers on a screen. They can vanish overnight, and in crypto they often do. Taking profits isn't about being bearish, it's about being smart. Most people wait too long, thinking they'll catch the exact top, but trying to time the peak usually ends with holding through the drop. You don't need to sell everything at once, but having a plan makes all the difference. Set targets. Decide in advance what kind of return you're happy with, and if the trade goes against you, be willing to cut losses and move on. This is also when people are most vulnerable to scams. When emotions are running high and you're either feeling greedy or desperate, that's always when fake giveaways, phishing sites, and wallet drainers sneak in. If something looks too good to be true, especially in a bull market, it probably is. So take profits, secure your capital, and don't let FOMO override your common sense. So those are 10 things I think every beginner in crypto needs to hear. Not the hype, not the recycled advice, just the kind of insight that actually helps you stay in the game. Most people don't make it past their first cycle, unfortunately. They get burned, they give up, and they walk away thinking crypto is a scam. But it's not. It's just a market that punishes people who show up unprepared. If there's one thing to take away from this video, it's that you don't need to be a genius to make it in this space. You just need to stay calm, manage risk, and understand how the game works. And the longer you're around, the more obvious that becomes. If you found this helpful, hit the like button, subscribe, and ring the bell so you don't miss the next one. And drop a comment. Which of these hit hardest for you? Or what's one lesson you wish someone told you earlier? Thanks for watching, and I'll see you in the next one.